What's up, everyone? Welcome to this Market Forces segment of the Hidden Forces podcast. My guest for this segment is Dr. Marc Faber, editor and publisher of the Gloom, Boom, and Doom report. Marc had been a frequent guest on my old television program Capital Account, but it has been some time since the two of us spoke. He is, needless to say, a very unique guy, and we cover a wide variety of topics in this conversation, from cryptocurrencies to issues of structural demographics, foreign exchange, and central banking. But what I really wanted to try and do, and you'll all have to be the judges of whether I succeeded in this or not, but what I was trying to do was to integrate a number of seemingly disparate ideas like central bank low interest rate policies, these ridiculous private valuations in some of these Silicon Valley tech companies, the search for yield, the disappearance of safety and financial assets, the rise in systemic instability, and so on and so forth, but to integrate these ideas under this larger umbrella of income and wealth disparity and how it is driving structural, cultural, and behavioral changes in the economy that are making it fundamentally incompatible with capitalism. To me, Uber's $70 billion valuation and its practice of subsidizing its consumers with billions of dollars of investor money in the hope that they might achieve a successful exit at some point or profitability at some point has many similarities to the Asian model of development, where the Chinese banking system, for example, would recycle domestic savings into the U.S. in order to make the goods of Chinese companies affordable to American consumers. These types of dynamics are not sustainable, and it's my hope when doing segments like this one that I can begin to bring to the surface some of these parallels for all of you to see. So I begin this discussion by asking Dr. Faber what he thinks some of the driving forces are in the global economy today and how they may drive changes in the future. We get into Bitcoin. I get his views on the rise of populism and how it might upset the apple cart. Marc has some strong opinions around war and what the prospects for that might be, particularly in Asia. Of course, Marc being Marc, we discuss gold. We also discuss stocks, specifically the new blue chip tech stocks and what his views are on those and on the broader market. And we end with Marc giving his advice on what he thinks is the single best investment anyone can make in today's market. So please enjoy. So Dr. Marc Faber, editor and publisher of the Gloom, Boom, and Doom report, joins us for this Market Forces segment of the Hidden Forces podcast. Dr. Faber, welcome to the show.
Thank you very much for having me on.
So let's get right to it. What do you think, well, what would you say are the driving forces in the global economy today, and how will we see these forces manifest themselves in financial markets going forward, given that, I should say, we are living in a world defined by the failures, some realized, some yet to be realized, of the last boom?
Well, I think that we live in a very complex world in the sense that the Western world is declining relative to emerging economies and certainly relative to Asia, including China and India. At the same time, we have in the Western world, for the first time, a generation of people, the millennials, who earn less and have less money when they are 35 years old than their parents had. In Europe, we have specific problems, including immigration, which will eventually be a huge problem. And then we have also huge changes in the way business is conducted as a result of automation and as a result of new disrupting technologies and disrupting companies such as Amazon and Uber and Airbnb. So it's not a clear-cut case. We also have a world where asset prices have been driven up very dramatically by central banks, asset purchases.
So you're touching on a number of things, actually. When I was sort of thinking about this interview and this discussion today, I sort of wrote out a number of things that I feel are forces with which we must contend going forward. One of them, of course, is the higher levels of wealth and income inequality, in part driven by central banking and the changes that we've seen in the banking system. Populism and potential changes in government policy. Again, those things are interrelated. You're also talking about technology and disruption, which is interesting, and you mentioned Uber. And I actually want to ask you something about that, because in your most recent newsletter, you made an interesting point about Uber, which is that Uber, putting aside its valuations, you made that point to recognize that you're not endorsing the valuations of $70 billion for Uber, but that Uber's business represents an attempt to resolve the need by consumers for lower-priced services in order to compensate for their higher living costs. And what I think is very fascinating about that idea that really resonates with sort of some larger issues you've mentioned is that one of the things I see in Uber's valuation is sort of inherent this income and wealth disparity and the rising asset prices, the hunt for yield, and sort of where we are today. Because the fact that investors have been willing to subsidize the rides of Uber customers, as has come out from recent news of the company, that they've been losing billions of dollars a year, and so much of that money goes towards subsidizing their riders, it seems to me very interesting and parallels in many ways the ways in which the Chinese saver was willing to subsidize the American consumer during the mortgage refinancing bubble, and it represents sort of the perversions in capital markets that have come about in large part due to many of the things that you've described.
This is correct, and I'd like to say that it's not just the Chinese that subsidize the American consumer and the overconsumption in the US. Every country that has a current account surplus, and the fact is also Europe has a large current account surplus with the US, subsidizes consumption in the US. And if you print money in Europe and in Japan, some of that money is flowing to the US because in a period of strengthening US dollar, institutions and individuals shift some of their assets into US dollars. So your observation is absolutely correct, and this continues up to this very date.
Speaking of the U.S. dollar and speaking of central banks, which is one of those things I mentioned there, what is your outlook for the dollar given the tightening path that the Fed is supposedly on and its supposed sort of intention to lighten its balance sheet?
Well, I think we have to distinguish in markets between short-term noise and shorter-term fluctuations and long-term trends. I believe that the long-term trend for the US dollar is down. Now, can the US dollar again strengthen against the euro to 105 or 108? Who knows? Possible. Everyone I know in the Forex market has been horribly wrong with predicting Forex movements. So I just don't know. But longer term, I think the US dollar is a doomed currency.
That's also very, yes, and that's part of the name of your report. It's interesting that you say that. I'm curious, sort of two questions. When you say that many of your friends and associates in the foreign exchange markets have been horribly wrong, betting against the dollar, it sounds like you're saying, A, do you see that as something that is more acute today than at other times? And if so, does that speak to something else, which is that we have seen, of course, with any type of prolonged economic structure, any kind of prolonged economic conditions, a certain congealing of the financial structure and behavior begins to take notice. We've seen that, of course, in the movement of investors out of active and into passive. What do you see as being some of the effects upon the investment class with these sort of current market conditions as we've had them looking forward? Do you see any kind of impact in the mentality of traders and in the investment class that will negatively impact their capacity to react to adverse market conditions going forward?
Well, I'd like to say this about markets. Say you have the wheat market, the corn market, the soybeans market, the copper market, the gold market, whatever it is, the futures positions are a multiple of what the physical market is. And so when a market move gets underway, the people or investors who are either short or long have to scramble to cover their positions. Let's put it this way. At the beginning of the year and at the end of the last year, investors were heavily short the euro and heavily long the dollar. And what happened? The dollar fell and the euro rose. And so these people who were short the euro had to cover. Right now, the euro has bias towards long positions. Investors are heavily long the euro. And if the euro starts to go down against the dollar, they will again have to reposition themselves. And so while the market seems to say that there is low volatility, I disagree. There is a lot of volatility in individual commodities, stocks, bonds, etc. And these market moves are then very strong. Say, up to 4 days ago, the grains market was very weak. Within just 3 days, the grains market has soared for no obvious reason. And so all I'm saying is the money printing of central banks has made markets much more volatile. And you will see if one day stocks go down, there'll be an avalanche of selling. But until that happens, we don't know.
You're saying essentially there's greater amounts of instability and a lot of pent-up volatility that is bound to unleash itself in the market.
There is a huge amount of instability, and that will have a huge impact on markets in due course, in everything, not just stocks or bonds or commodities, in just about everything.
Well, it's interesting. Another sort of theme that I was thinking about before this interview is one of change. And change is omnipresent in life. And we're in certain moments, in certain places, more able to embrace change and go with the flow, so to speak. In other cases, we are resistant to change. And I do see one great example is the crisis of 2008 and the way in which the global central banks and governments reacted to the change in market valuations. They resisted it dramatically, intervened, and so we're living in the aftermath of that. I wonder, what do you see going forward that could instigate the type of change that would result in a dramatic repricing of risk, of assets, of everything, in equities, in bonds, and commodities, etc.?
Well, I suppose that if I were able to tell you exactly what will reprice asset prices down, other people would also know about it. And asset prices fluctuate. That is inevitable, whether they are interventions or not, but they fluctuate. And we are at a very high level of asset prices. Now, what will reprice them down? I don't know precisely. But what about the war with North Korea? What about confrontation in Syria with Russia? What about rising interest rates that are more pronounced than is expected by the market? I'm not expecting it, but it could happen. What about a weak economy? So there are many factors, many things that could lead to a repricing of equities. And the most important, in my opinion, is when asset markets will start to go down. this will trigger selling. And in my opinion, rather massive selling.
And your reason being for that? Are you talking about some of the changes that we've seen in terms of investment strategies and protocols?
I'm talking about essentially the factors I just mentioned, from wars in Southeast Asia or North Asia, and war in eastern Ukraine and in Syria. And I'm talking about simply asset prices no longer going up. Why in the last 10 days have the FANG stocks performed poorly? Give me one reason. They performed poorly because they started to go down, and the institutions who are overweight these FANG stocks started to liquidate. And this liquidation could go on and likely to go on. So all I'm saying is you don't need to ask what will trigger the decline of asset prices. You just have to watch asset prices, and if they decline, they can decline a lot.
And that speaks, of course, to the momentum aspect of this equation. And that brings up another question that I have for you is, to what extent do you feel that this move out of active into passive investment strategies, in large part due to the fact that interest rate policy and government policy have made it very challenging for active investors to make returns in this market, do you see that as being an unusually inflammatory feature of a downturn this time around?
Not necessarily, and I have to clarify one point. In my opinion, the shift from active to passive is mostly induced by active managers and their consultants. The consultants will go to an active manager and they will say, well, your benchmark is, say, the S&P 500. So the active manager invests money similar to the S&P 500. He doesn't digress a lot, because if he doesn't and something goes wrong, say, if you have in the S&P a weighting of one sector of 10%, and you weighted with 20 or 30%, and you're wrong, since the client told you to benchmark it to the S&P 500, he may sue you. So the active managers have been kind of forced to invest like the S&P 500. And of course, because they have to charge fees, unlike ETFs and unlike index funds, their performance will lag. But this is because they're prevented from going far away from the index.
And that is a relatively new feature. That relates to a particular regulation that was passed in recent years, correct?
Correct. Look, I started to work in 1970 on Wall Street. Until just about 5 years ago, nobody ever talked of indexing. There were some funds that invested according to an index because they claim that the index will perform better than the active managers. But it was not a widely accepted principle. Nowadays, everything is indexed. And so because everything is indexed, it's very difficult for a manager who manages pension fund money and large institutional money to outperform the index. Because if he doesn't perform similarly to the index, say the index is up 20% and he's down 20%, he's going to get a lawsuit, I guarantee you.
You mentioned technology as well. In your writings, and I should also mention for our audience who may not know this, do I remember correctly having seen and read a number of your quotes in March of 2009 calling the bottom, not just in equities, but also the imminent intermediate decline of the dollar? You had really nailed that in March of 2009, correct?
Yes, I've been relatively positive about equities starting the end of 2008, especially for Asian equities. And I was interviewed on March 6, 2009 by Bloomberg, and I said, the market is grossly oversold, and it's based on sentiment indicators. It's at the buying level. At the time, many observers and famous forecasters predicted that the S&P would go down to 400. On March 6, 2009, it was at 666. So yes, I caught the bottom very well. What worries me now is that we've gone up a long way and that actually the economy hasn't improved very much.
Well, that's the thing that's also very interesting. Every cycle is obviously different, but this cycle, it's hard to sort of compare to anything else. In the 2000s, we had a credit-fueled bubble driven by the housing market, mortgage refinancing, and a consumption boom. In the late 90s, we had a technology boom, but the technology boom that we had in the late 90s did not feel like what we have today, which feels much more sort of niche and isolated to certain parts of the economy. And I wonder also to what extent that really comes down to a very different level of participation. The fact that fewer people are participating in this cycle, how does that factor into your thinking around the next wave down for prices?
Difficult to tell. It is clear to me that a lot of investors lost a lot of money in 2000 to 2003 when the Nasdaq broke, because at that time, if you bought Newmont Mining or BHP or any stock, you were old-fashioned. You had to buy the new economy type of securities. And when they went down by, in some cases, 90%, a lot of investors lost money. Then came the housing bubble. Most people have a significant portion of their money in housing, in homes. And when it collapsed, because they're all leveraged, you understand? It's not that they buy a house and pay cash for it. They buy a house, and at that time they borrow 90% of the house. And even today, there's a lot of leverage in real estate. And when it went down, lots of people lost a lot of money. So if you go today to a retail brokerage firm in the US, the business from individuals is very small. The business really comes from financial institutions, mutual funds, passive funds, and high-frequency traders. But the individual is not in the market.
And of course, that is reflected in these very high pre-IPO valuations for companies like Uber. Where do you stand on the issue of structural demographics? When I say where do you stand, what I mean is how significant of a force do you think that is a drag, for example, on future consumption, of course, from the baby boomers, but also the fact that these baby boomers are looking to consume off of the interest that they're gaining from, in part, the debt that is weighing down the future productive earners in the society. In other words, it also speaks to this imbalance of debt in society.
Yes, some people say the overall level of debt doesn't matter because it's owed to other people. But the fact is, wealthy people are very wealthy, extremely wealthy, and have no problem with that. But the people that owe the debt, they're highly leveraged, and they have to wait for their paycheck until the end of the month to meet their credit card debt payments. And so it's unequally distributed. And I think that, according to various sources and various what I would consider reliable statistics, 50% of Americans have practically no savings. Practically no savings. Now, this is happening at a very inopportune time, in the sense that the unfunded pension fund liabilities keep on going up. They're huge. And you ask yourself, so here you have a population where most people have no savings. They rely maybe for their retirements on their pensions or on Social Security. But both the pension funds and Social Security have no money. And so who's going to pay for it? Now you may say, well, the government will bail them out. Yeah, but the government has also a huge debt. So the debt will go up. So what will happen is that the Federal Reserve and other central banks, this is not endemic to the US. In Europe, we have the same problem with unfunded pension fund liabilities, but maybe to a lower extent. But nevertheless, we have the problem. So the money printing, in my opinion, will continue.
And so what you're saying is essentially the suggestion by the Federal Reserve, in this case, to shrink its balance sheet will actually be something that they will have to reverse or renege on, and in fact go the path of Japan. And I was actually looking at some recent numbers from, it looks like the BOJ and the Investment Trust Association of Japan, that approximately 67% of the nation's ETFs as of February of this year, of 2017, are owned by the BOJ, which is a pretty remarkable number.
Correct. And you ask yourself, where do we go with this kind of central banks essentially financing the whole government? It may work for a while, but it's not going to work for the long term. And so I'm very negative about the global economy, which has recovered because of a huge debt buildup financed by central banks. But who knows how long it will last? Maybe it can last another 3 years, maybe another 10 years, but it's not going to last forever. And when we hit the wall, it's going to be very dramatic.
Well, one of the other things that sort of comes to my mind when I'm hearing you speak about this is the difficulty of identifying safe assets. Of course, years ago, the normal strategy one would implement if one was feeling risk averse would be to buy government bonds. But of course, you can't do that today. How does someone go about creating synthetically safe assets?
Tragically, when I grew up, and for a long time, safe was a deposit in the bank. Safe was, as you said, government bonds. Riskier were corporate bonds. And the riskiest were equities. And then people kept a little bit of gold under the mattress or wherever it is. And nowadays, to be honest with you, nothing is safe. You buy bonds. As you know, the yield on the 10 years in the US is 2.5%. That's the maximum you can earn. And that may be also what you earn. And maybe bond yields will go down from 2.3% at the present time to 1%. Who knows? Maybe, could be. I don't know. You buy equities. Equities can go up and they can go down. Then you buy real estate. As we know, it can go up and it can go down. And some real estate has actually already declined. High-end luxury, and say, if you adjust the weakness for the British pound for the US dollar, then London properties have already dropped, say, 30-40%. So please explain to me what is safe. Precious metals can move up, they can move down.
And they can also be confiscated.
I think precious metals are relatively safe under one condition. And the condition is that the governments, I have to say, the wise governments of our Western world don't take it away from you. That is an option that is available to them. And I think that it's not unlikely that this will happen.
I know that you're not someone who invests in or has any knowledge of Bitcoin or the blockchain protocol, but do you think that the reaction in that market is partly due to concerns around property rights and, for example, the way in which a lot of money has left China to go? I mean, when I say a lot of money, let's be clear, we're not talking about huge sums here, but Bitcoin's a very small market still, but that this small market reflects in some way the concerns around property rights and being able to protect one's savings in this extremely uncertain world?
Look, I believe that the people who buy FANG stocks, and we have statistics from the website robinhood.com, what the millennials buy. They buy Snap, Amazon, Netflix, Apple, and Google, and so forth, Micron Technology. All the speculative stocks they buy, these are the same buyers of Bitcoins. Now, I'm not an expert on Bitcoins, but is a Bitcoin worth $2,000, $3,000, or $10,000, or $1 million? Or is it worth nothing? That we don't know. I know so many people who, for a living, trade Bitcoins. And in my opinion, when this happens, usually big setback can also happen. So I'm not interested in Bitcoins for the simple reason that if I believe in, say, a crisis, how can a crisis happen? Someone may switch off your electricity. Someone may switch off your internet. Someone may switch off your water, all at the same time. If the internet is switched off, please go to a department store or grocery store and buy some fruits or food. You think they will accept your credit card?
Well, certainly.
You understand? That's yeah. The difference between having physical gold and these other items that are dependent on the internet functioning. And that's why I also strongly oppose currencies or the elimination of cash. If I have $100 bank bill in my hand, I can give it to a taxi driver if my credit card doesn't work. And sometimes, even today, when everything is functioning, my credit card doesn't work because it's been blocked by the credit card company for whatever reason. It's not the reason that I didn't pay my bills, but it may be another reason. So all I want to say is, if you want to be safe, don't put the insurance policy for safety into something that is dependent on high technology.
Sure, we're in deep trouble if we lose internet connectivity. I think what's interesting with respect to Bitcoin is the larger tension between centrally organized and decentrally organized systems and societies and et cetera. So I think that's interesting, and I think also its demand represents some type of relationship between the forces we were describing before and the flight to safety. I also think conceptually,
actually, the Bitcoins are not bought by people by and large for safety. People buy them and sell them for speculation. That's 90% of the Bitcoin trading.
No, correct. Absolutely. I didn't mean to suggest it that way. I meant really actually my point with that had to do with using Bitcoins to take money out. So let me ask you this. How do you see populism? I mean, we've seen, of course, these changing forces of populism with respect to elections in Europe and in the United States. How significant of a role do you think that will play going forward? Because in so many ways, I feel thinking about things just in terms of asset pricing and what financial markets represent and reflect can miss some of the ways in which the costs are shifted to other areas of society. And I think one of the steam valves for that is elections and populism. What role do you see that playing going forward in financial markets and in society?
Well, I think that's a very good question. And you asked me before what will trigger a downturn. Personally, I believe that, my friend Albert Edwards at Societe Generale, he wrote a report that the people will turn their anger at central banks. I don't believe that they will make the connection between the wealth inequality and their poverty and central banks. You understand? And
Sure.
Money printing. But I believe a politician who is clever can one day tell the majority of people who are, as I said, 50% of Americans have no money. They can tell the people easily, look, the reason you are poor and have difficulties in meeting your expenses every month is that the rich have taken too much money from you. And let's go after the rich. And so when you ask me what is a safe asset, I tell you there's nothing that is 100% safe. They will go after the rich people, and I see this. They claim, we're going to cut taxes. Yeah, they may cut federal taxes, but local taxes, I've never seen local taxes going down. They go up every year. So people end up paying large taxes. And if the direct taxes, income taxes, in other words, don't go up, the GST, the sales taxes go up. So this is an additional reason why the economy is soft. People don't pay less tax. They pay more tax than before.
On this issue of technology, Dr. Faber, I wonder if you think at all about the relationship between capital and labor and how it's changed over the decades from when you got into banking and even from before that, from as far as you can remember and study. In my estimation, it seems that one of the driving forces for change in the economy is the increasing value of capital relative to labor, and that is part of the driving element for the inequality in incomes or the wealth disparity and income disparity in the economy. How do you view that as a person who's been in this industry and as someone who has sort of made it his business to think about and review society and social trends and financial trends? How do you see that? Do you think about that at all?
Yes, of course. I'd say until the late 60s, labor in the US was very highly paid relative to corporate profits. And labor in the US in the late 60s, before the dollar devaluation began in 1971 against the European currencies, labor, if they traveled to Europe, they lived like kings because Europe was very cheap compared to the US. Nowadays, labor is really stuffed. If you look at the labor percentage of GDP and you look at corporate profits as a percent of GDP, they went in different directions. Labor as a percent of GDP declined massively, not a little, massively, and corporate profits went up massively. Now I want to ask you something. Let's say you have a factory and you have 20 machines and 1,000 workers, and interest rates are at zero. Don't you think that maybe it's a good idea to buy another 20 or 50 machines and cut your labor force? Interest rates are zero, your capital cost is zero. So in my opinion, central banks have actually accelerated this decline in the standards of living and earnings of working people, and have favored entrepreneurs who are installing the capital goods. And this is only going to continue with the emergence of robots. With a robot, I can produce goods. I don't have to pay him Social Security. I don't have to pay him health care and so forth. And I think a lot of labor will find that they are obsolete. I'm sorry to say that, and it's painful. That's why I said at the beginning, we are in the midst of huge changes in the relative decline of the Western world against emerging economies, particularly in Asia, and also changes in technology.
No, I agree, and I think all of these things actually work in unison. The other thing I was thinking about as you were speaking, and we spoke about this, we touched on it with respect to Uber and the valuations of Uber and the way in which the wealthy investors of Uber are effectively subsidizing the very customers who they're looking to profit from in some way. That reflects the search for yield, which is in part a reflection of many of wealth being concentrated in few hands, not just the low interest rates, but certainly something that was fueled by and benefited from bailouts and interest rate policy. But I think also what's very interesting is the flip side of that equation, Dr. Faber, which is the same force that drives the search for yield, drives the deflation in a turning market psychology. Do you feel that? In other words, do you feel that we are more primed for larger declines in asset prices as a result of the fact that, of course, absent central bank full intervention, we have to take that into account, but that we are more inclined for a decline due to the fact that the normal sort of middle class distribution of wealth has changed, that people would then result to just looking for safety in a way that they wouldn't have in a different market?
As I mentioned to you, basically, in the Western world, the standards of living of the median household has gone down because wage growth has been inferior to the cost of living increases, including insurance premiums, taxes, rentals, and so forth, health care. And as a result of that, some smart entrepreneurs came along and said, okay, these people have no purchasing power. We have to supply them with something that is cheaper. Uber is by and large cheaper than a taxi, by and large. Not always, but by and large. And Amazon is more efficient at delivering products than Sears and JCPenney. So these companies, they essentially destroy, in the case of medallion prices in New York, they destroy the value of a medallion by, say, 70%, maybe 80, maybe 60, but they destroy the value of medallion. That's an asset, okay? In the case of retailing, Amazon destroys entire retail centers, shopping centers, and so forth. So what you just pointed out, the Fed's policies, it's not only the Fed, there are also fiscal policies to consider. But basically, the Fed has contributed massively to the average household's wealth going down in real terms. And then some companies come in and they take advantage of that, and they actually re-accelerate or accelerate the trend to lower prices. And so if retailers close down, what happens to real estate prices in that area? They'll go down. So yes, the Fed has created a trap where their policies have led to deflationary forces.
And of course, with what you're describing there with Amazon and Uber, there is a sort of cannibalization of your customer base. In a way, you're relying on a business model that relies on people who are becoming increasingly irrelevant in the equation. With self-checkout, we see that as well, just as one small example in retail and supermarkets, etc. Dr. Faber, you've been very gracious with your time. I don't want to take up any more of it, but I do have one question. Even a question or a conversation around the subject of gold is taken very differently in Asia. I wonder, how do you see the opportunities for Asia, both the near-term effects of what we're describing, even the effects on emerging markets of potential dollar liquidity with this balance sheet unwind, but how do you see sort of the short and then more the long-term prospects for Asia, and where do you find the best investment opportunities there going forward?
Well, correct. I lived in Asia since 1973. And obviously, we had huge market fluctuations. In 1973-74, in the global bear market for equities, the Hong Kong stock market dropped precisely by 90%. And the low on the Hang Seng Index was 150, 150. The Hang Seng Index is now over 20,000, okay? So if you look at the long-term chart of the Hang Seng Index, the Hong Kong Index, the 90% decline in 73 doesn't even show up, hardly shows up. Asia is a region, in my opinion, that will continue to grow at a higher rate than Europe or the US, provided, and I repeat, provided there is peace. China is becoming the center of Asian economic activity. It wasn't that way in 1970, it wasn't that way in 1980, when the saying was, if the US catches, or if the US sneezes, Asia catches a cold. You understand? Everything depended on the US at that time. Nowadays, everything depends on the Chinese economy. And in my view, the US doesn't like the rise of China. And the Chinese want to have more say in global affairs, and in particular, and from an Asian perspective, everybody understands that they want to control the supply chains to Asia. In other words, they feel threatened by the US military and naval presence in Southeast Asia. China doesn't have any overseas bases, but the US, just in Asia, only in Asia, has maybe 15. So the Chinese and the US are developing rising tensions. And if there is a conflict in Asia, then stocks, in my opinion, will tumble. It may not happen. Maybe there is no conflict, and through negotiations and diplomacy, problems can be solved. But with the current administration in the US, I don't think that there is a lot of diplomacy in place. And so I'm saying Asia will grow. Undoubtedly, it will happen, even with the Western world not growing much, but they can grow internally by, say, 4 to 5% easily. But if there is war, then all bets are off. Now, if you ask me about the valuations in Asia, since I'm a large investor in Asian securities, I can tell you I don't see anything that is particularly cheap. I don't see anything that is in a bubble either. You understand? We're at median valuations, at reasonable valuations, but it's not cheap. It is not terribly expensive. But if I had to take a bet, I would say most global markets depend on the S&P. If the S&P is tonight up 50 points, the Asian markets will open up. If the S&P is down 20 points, then Asian markets will react on the downside. Everything is to some extent correlated. Now, in the last few years, both Europe and Asia has grossly underperformed the US. That underperformance has, in my opinion, come to an end at the end of last year. And from here on, Asia and Europe will outperform the US. But with interruptions, and if everything goes down, everything will go down. Then maybe in the US you lose 40% and in Asia only 35%. Who knows? But in general, I feel quite comfortable with Asia, with the concern I just expressed that there could be war.
Well, I think what our conversation has sort of touched on in many different ways is that there's a great degree of instability in the world and a lot of potential volatility, and navigating that is not something that one can do with a sort of a formulaic approach. It's just something that you would have to sort of, feel your way through as it begins to occur, because everything is uncertain. There is no standard safe asset class. There is no standard strategy. And of course, it's very difficult, even though there are many opportunities, as you say, in Asia. For someone who's not living in Asia, those opportunities can be very difficult to identify.
Today's world is money-driven, is materialistic. I would say a great asset is your knowledge.
Absolutely.
Is what you can do yourself in life. Can you fix a house? Can you work somewhere? Your skills. That is an asset. But if you ask people about assets, they only think about real estate, stocks, bonds, anything. But they never think about their own value.
I couldn't agree with you more. I think that that's an absolutely salient point.
Yes, I think people measure their wealth according to, the Cadillacs they have at home and the Rolls Royces and whatnot. But in a really emergency situation, your survival skills are very important. Also, your skills to adapt
Absolutely.
to hardship for a while.
Absolutely. And I think, again, that brings us back to the point of change. We're in a world that is changing, and in certain measures changing faster than it ever has before. I couldn't agree with you more. Dr. Faber, thank you so much for taking the time to speak with me this evening, and thank you, all of you out there, for taking the time to listen in on my conversation with Dr. Faber. If you enjoyed this segment and you want to learn more about the show, the segments, the episodes, then visit our website at hiddenforcespod.com. Lastly, if you are listening to the show on iTunes or Android, make sure to subscribe. If you like the show, write us a review. And if you want a sneak peek into how the sausage is made, or for special storylines told through pictures and questions, then like us on Facebook and follow us on Twitter and Instagram at Hidden Forces Pod.